Okay, reading 16, now on the economics section of the CFA Level 1 program curriculum reading. Now on aggregate output, prices, and economic growth. So the learning outcomes to calculate and explain gross domestic product using expenditure and income approaches. Compare the sum of value added and value of final output method of calculating GDP. Compare nominal and real GDP and calculate and interpret the GDP deflator. Compare GDP, national income, and personal disposable income. Explain fundamental relationship between savings, investments, and fiscal balance and the trade balance. Explain the IS and LM curves and how they combine to generate the aggregate demand curve. Explain the aggregate supply curve in the short run and the long run. Explain causes of movement along and shifts in the aggregate demand and supply curves. Describe how fluctuations in aggregate demand and aggregate supply causes short-run changes in the economy and the business cycle. Distinguish between the following types of macroeconomic equilibria: long-run full employment, short-run recessionary gaps, short-run inflationary gaps, and short-run stagflation. Explain how short-run macroeconomic equilibrium may occur at the level above or below full unemployment or full employment. Analyze the effects of combined changes in aggregate supply and demand on the economy. Describe sources, measurements, and sustainability of economic growth. Describe the production function approach to analyzing the source of economic growth. Distinguish between input growth and growth of total factor productivity as components of economic growth. Introduction. In the field of economics, microeconomics is the study of the economic activity and behavior of individual economic units, such as a household, a company, or a market for a particular good or service. And macroeconomics is the study of the aggregate activities of households, companies, and markets. Microeconomic fact focuses on national aggregates, such as total investments and amount spent by all businesses on plant and equipment, total consumption, the amount spent by all households on goods and services, the rate of change in the general level of prices, and the overall level of interest rate. Macroeconomic analysis examines a national's aggregate output and income, its competitive and comparative advantages, the productivity of its labor force, its price level and inflation rate, and the actions of the national government and central bank. The objective of macroeconomic analysis is to address such fundamental questions as what is the economy's aggregate output and how is aggregate income measured. What factors determine the level of aggregate output/income for an economy? What are the levels of aggregate demand and aggregate supply of goods and services within a country? Is the level of output increasing or decreasing, and at what rate? Is the general price level stable, rising, or falling? Is unemployment rising or falling? Are household spending or saving more? Are the workers able to produce more outputs than a given level of input? Are businesses investing in and expanding their productivity capacity? Are exports or imports rising or falling? From an investment perspective, investors must be able to calculate the country's current economic environment and forecast its future economic environment in order to identify asset classes and securities that will benefit from economic trading occurring within a country. Macroeconomic variables such as the level of inflation, unemployment, consumption, government spending, and investments affect the overall level of activity within a country. They also have different impacts on the growth and profitability of industry within a country, the company within these industries, and the returns of the securities issued by these companies. This reading is organized as follows. Section 2 describes gross domestic product related measures of domestic output and income. Section 3 discusses short run and long run aggregate demand and supply curves, the causes of shifts and movements along these curves, these factors that affect equilibrium, levels of output, prices, and interest rates. Section 4 discusses sources, sustainability, and measures of economic growth. A summary of the practice problems completes the reading. Part 2, aggregate output and incomes. The aggregate output of an economy is the value of all goods and services produced in a specific period of time. The aggregate income of an economy is the value of all the payments earned by the suppliers of factors used in the production of goods and services. Because the value of output produced must occur, the factors of production, aggregate output, and aggregate income within an economy must be equal. These are four broad forms of payments, i.e. incomes, compensations of employee, rent, interest, and profit. Compensation of employees include wages and benefits, primarily employer contributions to private pension plans and health insurance. The individual receives in exchange for providing labor rent. For providing labor, rent is payment to use for proper use of property. Investment is payment for lending funds. Profit is the return of that owners of a company receive for the use of their capital and the assumption of financial risk when making their investment. Although businesses that are directly owned are much of the property and the physical capital in the economy. By virtue of owning the business, households are the ultimate owners of these assets and hence the ultimate recipients of the profits. In reality, of course, a portion of the profit is usually retained within the business to help finance maintenance and expansion capacity. Similarly, because the government is viewed as operating on a non-profit basis, any revenue is received from ownership of companies and or property may be viewed as being passed back to households in the form of lower taxes. Therefore, for simplicity, it is a standard in macroeconomics to attribute all income of the household sector unless the analysis depends on more precise accounting. Aggregate expenditure is the total amount of the total amount of spending on goods and services produced in the domestic economy during the period must be equal to aggregate output and aggregate income. However, some of these expenditure may come from foreigners in the form of net exports. As aggregate output, aggregate income, aggregate expenditure all refers to different ways of composing the same quantity. Exhibit 1 illustrates the flow of inputs, outputs, incomes, and expenditures in a very simple economy. Households supply the factors of production, labor, and capital to businesses in exchange for wages and profit, which are the aggregate income totaling £100. These flows are shown by the top two arrows. Companies use the inputs to produce goods and services, which are the aggregate output, which they sell to households. Aggregate expenditures for £100, the output, and each expenditure flows are shown by the bottom two arrows. Aggregate output, income, and expenditure are all equal to £100. In this simplified example, households spend all their income on domestically produced goods and services. They do not buy foreign goods, save for the future, or pay taxes. Similarly, businesses do not sell to foreigners or governments and do not invest to increase their productive capacity. The important component of this economy will be added in section 2.2, but first we need to discuss how output and income are measured. So this is a circular flow. The output, income, expenditure in a simple economy, the circular flow. This is a really simplified example. We also have the international market. We also have governments. We also have financial institutions. Those of which are all not represented within this Exhibit 1 circular flow. 2.1 Gross Domestic Product. Gross Domestic Product, GDP, measures the market value of all final goods and services produced within the economy at a given period of time, or the output definition, or equivalently, the aggregate income earned by all households, all companies, and the government within the economy is the given time period, or the income definition. Intuitively, GDP measures the flow of output and income in the economy. GDP represents the broadest measure of value of economic activity occurring within a country during a given period of time. Therefore, GDP can be determined in two different manners. In the income approach, GDP is calculated as the total amount earned by households and companies in the economy. In the expenditure approach, GDP is calculated as the total amount spent on the goods and services produced within the economy during a given period. For the economy as a whole, total income must equal total expenditure, so the two approaches yield the same result. Many developed countries use a standardized methodology for measuring GDP. This methodology is described in the official handbook of the Organization for Economic Cooperation and Development, or the OECD. The OECD reports the national account of many developed countries. The United States, the National income product account, also called the NIPA or National Account for short, is the official U.S. government accounting of all the income and expenditure flows in the U.S. economy. The national accounts are the responsibility of the U.S. Department of Commerce and are published by the Survey of Current Businesses. In Canada, similar data are available from Statistics Canada, whereas in China, the National Bureau of Statistics of China provides the GDP data. To ensure GDP is measured consistently over time and across countries, the following three broad criteria are used. All goods and services included in the criteria must be produced during the measurement period. Therefore, items produced in previous periods, such as houses, cars, machinery, or equipment, are excluded. In addition to transfer payments from government sectors to individuals, such as unemployment compensation or welfare benefits, are excluded. Capital gains that accrete to individuals when their investment appreciates in value are also excluded. The only goods and services included in the calculations of GDP are those who can be determined by being sold in the market. This enables the prices of goods or services to be objectively determined. For example, a liter of extra virgin olive oil is more valuable than a liter of spring water because the market price of extra virgin olive oil is higher than the market price of spring water. The value of labor used in activities are not sold on the market, such as commuting, gardening, etc., is also excluded from GDP. By products of production processing are also excluded from if they have no explicit market value, such as air pollution, water pollution, or acid rain. Only the market value of final goods and services is included in the GDP. Final goods and services are those which are not resound or intermediate goods, or goods that are resold or used to produce another good. The value of intermediate goods are excluded from GDP because additional value is added during the production process. And all the value added during the entire production process is reflected in the final sell price of the finished good. An alternative approach to measuring GDP is summing all the value added during the production and distribution process. The most direct approach, however, is to sum the market value of all the final goods and services produced within the economy in a given time period. Two distinct but closely related measurement methods can be used to calculate GDP based on expenditure, value of a final output, and sum of value added. These two methods are illustrated in example 2. In this example, a farmer sells wheat to a miller. A miller grinds the wheat into flour and sells it to the baker, who makes bread and sells it to the retailer. Finally, the bread is sold to retail customers. The wheat and flour are both intermediate goods in this example because they are used as an input to produce another good. Thus, they are not counted directly in GDP. For the purposes of GDP, the value of the final product is €1, which includes the value added by the bread retailer as a distributor of a bread. If, in contrast, the baker sold directly to the public, the value counted in GDP would be the price at which the baker sold the bread, which is 78 euro cents. The left column of the exhibit shows the total revenue received at each stage of production of the process, whereas the right column shows the value added at each stage. Note that the market value of the final product, €1, is equal to the sum of the value added at each of the stages. Thus, the contribution of GDP can be measured as either the final sale price or the sum of the value added at each stage. Okay, here's an example. 2.2.1. Let me drink water real fast. As a general rule, only value of goods and services whose value can be determined by being sold in the market are included in the measurement of GDP. Owner-occupied households and government services, however, are two examples of services that are not sold on the marketplace but still included in the measurement of GDP. When a household or individual rents a place to live, he or she is buying housing services. The household pays the owner of the property rent in exchange for shelter. The income that a property owner receives is included in the calculation of GDP. However, when a household purchases a home, it is implicitly paying itself in exchange for the shelter. As a result, the government must estimate or impute a value for the owner-occupied rent, which is then added to the GDP. The value of government services provided by police officers, firemen, judges, and other government officials is a key factor that affects the level of economic activity. However, valuing these services is difficult because they are not sold in the market like other services. Individual consumers cannot decide how much to consume or how much they are willing to pay. Therefore, these services are simply included in the GDP at their cost, e.g. wages paid, with no value added attributed to the For simplicity, the global comparability, the number of goods and services with imputed values are included in the measurement GDP are limited. In general, non-market activities is excluded from GDP. Thus, activities performed for one's own benefit, such as cooking, cleaning, and home repairs, are excluded. Activities in so-called underground economies or the black markets are excluded. The underground economy reflects economic activity that people hide from governments, either because it is illegal or because they're attempting to evade taxation. Undocumented laborers who are paid off the books are one example. The illegal drug trade is another. Similarly, barter transactions such as neighbors exchanging services with each other, for example, helping your neighbor repair her fence in exchange for plowing your garden, is also excluded from GDP. Exhibit 4 shows estimated size of underground economy versus countries as a percentage of nominal GDP. The estimate range of 8% in the United States and 60% in Peru. Based on these estimations, the U.S. national income account fails to account for roughly 7.8%. or 8 out of 108 of the economic activities, whereas Peru, the national account is roughly 37.5%, which is around 60 out of 160 of the economy. For most of the countries shown, the national account misses around 12 to 20% of the economy. So here's a list exhibit 4 is quite interesting. China is actually rather low. That's kind of surprising. Okay. It should be clear from the estimates that the underground economy that the reliability of the GDP data varies considerably across countries. Failure to capture a significant portion of activity is one problem. Poor data collection practices and unreliable statistical models within the official data accounts are also potential problems. 2.1.2 nominal and real GDP. In order to evaluate the economy's health, it is often useful to remove the effect of changes in general price levels on GDP because higher or lower income driven solely by changes in the price levels is not an indicative of higher or lower levels of economic activity. To accomplish this, economists use real GDP, which indicates what would have been the total expenditure on the output of goods or on services if prices were unchanged or inflation is not taken into consideration. Per capita real GDP divided by the size of the population has often been seen as the measure of the average standard of living in a country. Suppose we are interested in measuring GDP of an economy for the sake of simplicity. Suppose that the economy consists of a single automobile maker and that in 2009, 300,000 vehicles are produced with an average market price of $18,750. GDP in 2009 would be this much. Economist defines the value of goods and services measured at current price to be the nominal GDP. Suppose in 2010, 300,000 vehicles are again produced, but the average but the average market price of the vehicle increased by 7% to this much. GDP in 2010 would be this much, even though no more cars were produced in 2010 than in 2009. It appears that the economy grew by 7% between 2009 and 2010, although in actuality, it did not grow at all. So this is where the importance of using real GDP comes into play and not just nominal GDP. So real GDP is equal to the nominal GDP divided by the GDP deflator divided by 100. So these are quite simple concepts. Pause the video and you can be able to see yourself. So nominal GDP will increase. Okay. 2.2, the components of GDP. Having defined GDP and discussed how it is measured, we can now consider the major components of GDP, the flows among the four major sectors of the economy: the household sector, the business sector, the government sector, and the foreign or external sector, comprising transactions with the rest of the world. And the market through which they interact as an expression of GDP based on the expenditure approach is GDP equals C equals plus I plus G plus X minus M. C is consumer spending for final goods and services. I is gross private domestic investment. G is government spending. X is exports. M is imports. So these are all really simple. If you have gone to university and studied any introductory economics course, you would have known this already. Exhibit 6 shows the flow of expenditure, income, and financing among the four sectors of the economy. And the three principal markets in this exhibit: solid arrows points in the direction of expenditure of the final goods and services. For simplicity, corresponding flows of outputs and are not shown separately. The flow of factors of production is also shown with a solid arrow. Financial flows, including income and net taxes, are shown with dashes or dashed arrows pointing to the recipients of the fund. Okay, so here's a lot. Here is a more comprehensive expenditure flow of the circular flow model. Okay. Pause the video if you need to see. Shouldn't be that hard. 2.2.1, the household and business sectors. The very top portion of Exhibit 6 shows the services of labor, land, and capital flowing through the factor market to business firms, and the flow of income back to the firms or to households. Households spend part of their income on consumption. C to save. S, part of their income for future consumption. Current consumption expenditure flows through the good markets to the business sector. Household savings flows into the financial market, where it provides funding for businesses that need to borrow or raise equity capital. Firms borrow or raise equity primarily to finance investments. I, in inventory purpose, property, plant, and equipment investment. I is shown flowing from firm through the good markets and back to the firm because the business sector both demand and produces the goods needed to build productive capacity or capital goods. In most developed economies like Italy and the United States, expenditure on capital goods represents a significant portion of GDP. Investment expenditure on capital goods account for approximately 21.1% of Italy's GDP in 2007, while the United States investment accounted for approximately 18.4% of GDP. In some developing countries, notably China, 40%, and India, 33.8%, investment spending accounts for a substantially larger share of the economy. As we will examine in greater detail later, investment spending is an important determinant of the economy's long-term growth rate. At the same time, investment spending at the most volatile component of the economy, and changes in capital spending, especially spending on inventories, are one of the main factors causing short-run economic fluctuations. 2.2.2, the government sector collects taxes from households and businesses. For simplicity, only the taxes collected from the household sector are shown in Exhibit 6. In turn, the government sector purchases goods and services G from the business sector or government spending. For example, the government sector hires construction companies to build roads, schools, and other infrastructure goods. Government expenditures G also reflects spending on the military, police, and fire protection, the postal services, and and other government services. Provision of these services make the government a major source of employment and in most countries to keep example 6 alive. However, government unemployment and the corresponding income are not explicitly shown. Governments also make transfer payments to households. In general, these are designed to address the social objectives such as maintaining minimum living standards, providing health care, and assisting the unemployed with retaining the temporary support and exhibit. 6. Transfer payments are subcontracted from taxes and reflect a net tax. Transfer payments are not included in government expenditure on goods and services. G. Because they represent a monetary transfer by the government of tax revenue back to the individual, which with no corresponding recipient of goods or services. The household spending facilitated by the transfer payments is of course included in the consumption. C, and hence GDP is worth noting that transfers do not always take the form of direct payments or to beneficiaries. Instead, a government may pay or even direct provide goods or services to individuals. For example, universal health care programs often work in this way. If, as is usually the case, government expenditure G exceeds net taxes. T, the government has a fiscal deficit and must borrow in the financial markets. Thus, the government may compete with businesses and financial markets for the funds granted by household savings. The only other potential source of funding is the economy, is capital flows from the rest of the world. These will be discussed in the next section. In 2017, the ratio of general government spending, which includes central government as well as states, provincial, and local governments, the GDP of Italy was 44.8%, while in the United States it was 31.2%. In countries where the government provides more services such as universal health care, in Italy, the government's contribution to GDP is greater. France's government sector represents 46.3% of the GDP. In the other countries, the public sector makes up a smaller share. For example, in Costa Rica, which has no standing army or navy, government spending of 16.1% of GDP. Exhibit 7 shows the data on the tax revenue, general government spending, and transfer payments as a share of nominal GDP. The external sector, trade, and capital flow involving the rest of the world are shown at the bottom right of the quadrant in Exhibit 6. Net exports X minus M reflects the difference between the value of goods and services sold to foreigners. Exports X and a portion of domestic consumption C, investment I. The government expenditure G that represents the purchase of goods and services from the rest of the world, inputs M. Balance of trade deficit means that the domestic economy is spending more on foreign goods and services than foreign economies are spending to connect. Spending on domestic, It bears emphasizing that trade and capital flows between the economy and the rest of the world must be balanced. Once the area's deficit is another surplus, and vice versa. This is an accounting identity that must hold in effect. Having allowed a country to run a trade deficit, foreigners must in aggregate finance it. Having the financing terms may or may not be attractive. Exhibit A reports the trade balance between the United States with selected countries. Note that Canada was the largest trading partner, both with terms of exports and imports, and in 2018, China is close to second, selling goods to the U.S. market. but China was not an important consumer of U.S. goods. Hence, the U.S. trade deficit with China was the largest by far overall. 2018 or 2008, the U.S. Balance of trade deficit was around 231.115 million. Okay, so here's Exhibit A. Continuation of Exhibit A. 2.3 GDP, national income, personal income, and personal disposable income. This section examines the calculation of GDP and other income measures in detail by means of an analysis of data from Statistics Canada. Exhibit 9 provides data from the level of Canadian GDP and its components measured at market prices, nominal GDP, leaving certain quantities to be determined. Okay. The exhibit shows two approaches to measuring GDP: the expenditure on final output measure, and the sum of the states to final users, and two, to sum the factors income generated in the production of final output. In theory, these two approaches should provide the same estimate of GDP as shown in the exhibit. However, in practice, they differ because they use the different data sources. The difference in account is accounted by the statistical discrepancy. Market analysis more closely follows the expenditure of Okay, so using the expenditure approach, Statistical Canada measure Canada's GDP by adding these economic activities all together. Note that in the Canadian National Income Account classifies a portion of government expenditure as gross fixed income. Not all countries makes this distinction. The United States, for example, does not. Also note that the change in business inventories must be included in expenditures. Otherwise, goods produced but not yet sold would be left out of the GDP. The income-based approach to calculating GDP is the sum of the factor income and essentially the measure of cost of the producing final output. However, two of the costs entering into the value and output are not really earned by factors of production. These items, the depreciation and indirect taxes, are discussed below. GDP is an estimate of the income approach as follows, and is calculated by using this formula. When GDP or when national income is the income received by all factors of production used in the generation of a final output. Compensation of employee, including wages and supplements to wages, which are primarily payments for pensions and health insurance. Corporate profits before taxes include these three items: dividends paid to households, undesirable corporate profits or retained earnings, and the main and that remains in the business sector. The three corporate taxes paid to government instead, interest income in the interest paid by businesses to households, governments, and foreigners to compensate them for the loan of a financial asset. Unincorporated net income, including rent. So that's quite straightforward. The capital consumption allowance, or the CCA, is a measure of the wear and tear or depreciation of the capital stock that occurs in the production of goods and services. This measure acknowledges the fact that some income/outcomes must not be allocated to replace the existing capital stock as it wears out. Loosely speaking, one of my dink of profit plus CCA as a total number as a total earned by capital, with the CCA being amount that must be earned and reinvented just to maintain the existing productivity of the capital. along with the GDP report. Statistics Canada also and other government statistical agencies provide information on personal income and savings. Personal income is a broad measure of household income and measures of ability to consume, to make purchases. As such, it is one of the key determinants of consumption spending proposal. Personal income is calculated by the national income subtracted by the indirect business taxes, subtracted by the corporate income taxes, subtracted by the undistributed corporate profits, subtracted by the transfer payments. Personal disposable income, PDI, is equal, not PDA, but PDI, for that public displays of affection, but personal disposable income is equal to the personal information, or the personal income less personal taxes. It serves or to save, and thus in the most relevant and most closely watched measure of the income for household spending and government decisions or saving decisions. Finally, household saving is equal to PDI less than 3 times consumption expenditure interest paid by consumers or into businesses. The personal transfer payments to foreigners, the corresponding manner of saving for the business school equal to distributed corporate profit, thus the capital consumption allowance. For 2009, where this much the tax outlaid for household in 2019 is different. This is part of the example. Okay, so I think I am done with part 3 of reading 16 of economics. I do hope my readings have been helpful, and hope to see you guys in the next part. We'll be continuing from 963. Okay, goodbye. Take care. Okay, CFA Level 1, continued reading on economics. Aggregate demand, aggregate supply, and equilibrium. In this section, we will build a model of aggregate demand and aggregate supply and use it to discuss how aggregate output and the level of price are determined in the economy. Aggregate demand, or AD, represents the quantity of goods and services that households, businesses, governments, and foreign customers want to buy at any given level of prices. Aggregate supply, AS, represents the quantity of goods and services producers are willing to supply at any given level of prices. It also reflects the amount of labor and capital that households are willing to offer into the marketplace at given real wage rates and cost of capital. 3.1 Aggregate demand. As we will see, the aggregate demand curve looks like the ordinary demand curve that we encounter in microeconomics. Quantity demanded increases as price levels decline. But our intuitive understanding of the relationship lower prices allows us to buy more of the good, which with a given level of income does not apply here because income is not fixed. Instead, aggregate income/expenditure is to be determined within the model along with the price level. Thus, we will need to explain the relationship between price and quantity demanded somewhat differently. The aggregate demand curve represents the combination of aggregate incomes and the price level at which 2 conditions are satisfied. First, aggregate expenditures equals aggregate income, as indicated in our discussion of GDP accounting. This must always be true after the fact. The new aspect here is the requirement that planned expenditures are actual or realized income. To understand the distinction, consider business inventories. If businesses end up with more inventory than they planned, then the difference represents unplanned or unintended businesses. Investment and actual output in the economy exceeds planned expenditure by the amount. Second, the available real money supply is willingly held by households and businesses. I'm drinking green tea today. The first condition, equity is of planned expenditures and actual income/output, gives rise to what is called the IS curve. The second condition, equilibrium, is the money market, is embodied in which which is called the LM curve. When we put them together, we will get the aggregate demand curve. Balancing aggregate income and expenditure, the IS curve, total expenditure on domestically produced output comes from four sources: household consumption, C; investment, I; government spending, G; and net exports, X minus M, where expenditures looks like this. So it literally looks like the GDP calculation model. Personal disposable income is equal to GDP, Y. So yeah, here's the calculation just using the GDP. The equation shows that domestic private savings is used to absorb in one of three ways: investment spending, I; financial government deficits, G minus T; and building up financial claims against overseas economies, positive trade balance, X minus M, when it's greater than 0. If there is a trade deficit when X equals X minus M is lesser than 0, then domestic private savings is being supplemented by inflows of foreign savings, and overseas economies are building up financial claims against the domestic economy. By rearranging the identity, we can examine the implications of government deficits and surpluses. G minus T is equal to S minus I subtracted by X minus M. The fiscal deficit of G minus T greater than 0 implies that the private sector may save more money, may save more than it invests, or when the S minus I is greater than 0. Or the country must run a trade deficit when X minus M is lesser than 0, or corresponding inflows of foreign savings of both. Equation 2 is the key relationship that must hold in order to for aggregate income and aggregate expenditure to be equal. Up to this point, we have treated it as simply an accounting identity. We now need to think of it as the outcome of explicit decisions on the part of household, businesses, governments, and foreigners. When we do so, we are faced with the question of what underlies these decisions and how the requisite balance is established. Economists have found that the dominant determinant of consumption spending is disposable income. This can be expressed formally by indicating that consumption is a function of C, of disposable income. Or dropping the technology correct by practicing insignificant adjustment for retained earnings and depreciation, a function of GDP minus net taxes. When household receives an additional unit of income, some proportion of its additional income is spent and the remainder is saved. The marginal propensity to consume, or the MPC, represents the proportion of an addition unit of disposable income that is consumed or spent. Because the amount of that is not spent is saved, the marginal propensity to save, or the MBS, is equal to the MPS. The marginal propensity to save is equal to 1 minus the marginal propensity to consume. These are in percentages. Or according to the consumption function, either an increase or in real income or a decrease in taxes will increase aggregate consumption. Somewhat more sophisticated models of consumption recognize that consumption depends not only on correct disposable income, but also on wealth. Except for the very rich, individuals tend to spend a higher fraction of their current income as their wealth increases, because with higher current wealth, there is less need to save to provide for future consumption. Exhibit 10 shows household consumption expenditures as a percentage of GDP for selective countries. Okay, so this is the marginal propensity to save and the marginal propensity to consume. These figures reflect the average propensity to consume, or the APC, that is the ratio of C divided by Y, consumption divided by income, rather than a measure of how the next unit of income will be divided between spending and savings, the MPC. However, there are reasonable proxies for the MPC in each country. Comparing Germany's 56.6% average propensity to consume with Mexico's 65.4%, the implication is that the Mexican economy is more sensitive to changes in disposable household income than the German economy. All other things being equal, macroeconomic policies that increases disposable household income, such as lowering government taxes, would have a larger impact on the economies of Mexico, or 65.4%, and the United States, 71.1%. The similar policies would have in Germany 56.6% and France 56.7%. Companies are the primary source of investment spending, or I. They make investment decisions in order to expand their stock of physical capital, such as building new factories or adding new equipment to existing facilities. A definition of physical capital is any man-made aid to production. Companies also buy investment goods such as manufacturing plants and equipment to replace existing facilities and equipment that wears out. Total investment, including replacement of worn-out capital, is called gross investment, and opposite to net investment, which reflects only the addition of new capacity. GDP includes gross investment, hence the name gross domestic product. Total investment spending is such the developed countries as Italy, Germany, and United Kingdom. The United States ranges between 18 to 22% of GDP in 2007. Investment decisions depend primarily on two factors: the level of interest rates and aggregate output/income. The level of interest rates reflect the cost of financing investments. The level of aggregate input serves as a proxy for the expected profitability of new investments. When an economy is utilizing its resources, interest rates are typically very low, and net investment spending often remains dormant because the investment returns on new investments is also low. Conversely, when output is high and companies have little spare capacity, the expected returns on new investments is high. Thus, investment decisions may be modeled as a decreasing function of the interest rate, nominal interest rate minus the expected rate of inflation, and the increasing function of the level of aggregate output. Formally, I equals IRY. Where I is investment spending, R is real interest rates, Y is as usual aggregate income. The investment function leaves out some important drivers of investment decisions, such as the availability of new and better technology. Nonetheless, it reflects the two most important considerations: the cost of funding, represented by real interest rates, and expected profitability of new capital, provided by the level of aggregate output. Many government spending decisions are insensitive to current levels of economic activity, the level of interest rates, the currency exchange rate, and other economic factors. Thus, economists often treat the level of government spending on goods and services, G, as an exogenous policy variable determined outside the macroeconomic model. In essence, this means that adjustments required to maintain the balance among aggregate spending, income, and output must occur primarily within the private sector. Tax policies may also be viewed as an exogenous policy tool. However, the actual amount of net taxes, or T, collected is closely tied to the level of economic activity. Most countries impose income taxes and value-added taxes, or VAT taxes, or both, that increases with the level of income or expenditure. Similarly, at least some transfer payments to the household sectors are usually based on economic need, and hence invested and inversely related to aggregate income. Each of these factors make net taxes, or T, rise and fall with aggregate income, Y. The government's fiscal balance can be represented as G subtracted by T equals G prime subtracted by T of Y, where G prime is the exogenous level of government expenditure and T of Y indicates the net taxes of increasing functions of aggregate income, Y. The fiscal balance decreases smaller deficits or larger surplus as aggregate income, Y, increases and increases as income declines. The effect is called the automatic stabilizer because it tends to mitigate changes in aggregate output. Net exports, X minus M, are primarily a function of income in the domestic country, and the rest of the world are the relative prices of domestic and foreign goods and services. As domestic income rises, some of the additional demand that is induced will be for imported goods. Thus, next exports will decline, and increase in income in the rest of the world will lead to an increase in demand for domestic countries' products, and hence an increase in the exports. A decrease in the relative price of domestically produced goods and services, perhaps because of the depreciation of the currency, will shift demand curves. Will shift demand towards products and hence increase net exports. We are now in a position to describe how aggregate expenditure and income are brought into balance. Slightly rearrange equation 2. Equality of expenditure and income implies this. Based on the discussion above, we know that both the government's fiscal balance and trade balance decreases as income rises because of net taxes and imports respectively. Hence, the right-hand side of the equation declines with income. This is shown by the downward sloping line in Exhibit 11, assuming the direct effect of higher income on saving is larger than the impact on investment. The left-hand side of the equation increases and income as income rises. This is shown to be the solid upward sloping line in Exhibit 11. Note that the line is drawn for a given level of real interest rates, or R0. The intersection of these curves shows the level of income at which expenditure and income balances. At higher levels of income, the saving investment differential, or S minus I, exceeds the combined fiscal and trade balances, implying that excess saving or insufficient expenditure. At lower levels of income, the saving investment differentiation is smaller than combined fiscal and trade balances, implying planned expenditure exceeds output. So this is what balancing aggregate income and expenditure looks like. The dash upward sloping line in the exhibit reflects a lower real interest rate, where R1 is lesser than R0. The line lies in the right of the solid line because any value of the saving investment differential, or where S minus I, is the higher level of investment reduced by the lower real interest rate, required a higher level of income to introduce higher savings. With a lower real interest rate, the curve intersects the higher rate of level of income. Thus, we see the equilibrium income and expenditure entails the inverse relationship between income and real interest rates. Economists refers to this relationship as the IS curve because investment I and savings S are the two primary components that address and maintain the balances between the aggregate expenditure and income. The IS curve is illustrated in Exhibit 12 in this next section. So here's the illustration of the IS curve. 3.1.2, equilibrium in the money market, the LM curve. The IS curve tells us what levels of income consist with a given level of real interest rate, but it does not address the appropriate level of interest rate, nor does it depend on the price level. In order to determine the interest rate and introduce a connection between the output and price level, we must consider supply and demand in the financial markets. To keep the model as simple as possible, we will deal explicitly with demand and supply for only one financial asset, money. All other assets, e.g. stocks and bonds, are implicitly treated as composite alternatives to holding money. In some of the subsequent discussions, however, we will note a differential impact on equity and fixed income securities. The quantity theory of money equation provides a straightforward connection among the nominal money supply, or the M, and the price level of P, the real income or expenditure of Y. MV equals PY. In the equation, V is the velocity of money, the average rate at which money circulates through the economy to facilitate expenditure. This equation essentially defines V. The equation begins to have economic content only when we make assumptions about how velocity is related to such economic variables as the interest rate. In the simplest case, if velocity is assumed to be constant, then the quantity theory of money equation implies that the money supply determines the nominal value of output, or the PY. Therefore, an increase in money supply will increase the nominal value of output. However, this equation alone cannot tell us how that increase would be split between price and quantity. The quantity theory equation can be rewritten in terms of supply and demand for real money balances. M divided by P is equal to KY, where K is equal to 1 divided by V reflects how much money people want to hold for every current unit of real income. The demand for real money balances is typically assumed it depends inversely on the interest rates, because a higher interest rate encourages investors to shift their assets out of money or bank deposits into high-yielding securities. Although the quantity theory of money suggests that the demand for real money balances is proportionally in real income, this need not be the case. The important point is that money demand increases with income. Thus, demand for real money balances is an increasing function of M, of real income, and a decreasing function of the interest rate. Equilibrium in the money market requires such. Holding the real money supply, or M divided by P, constant, the equation implies a positive relationship between real income, or Y, and the real interest rate of R. Given the money supply, an increase in real income must be accompanied by an increase in the interest rate in order to keep the demand of real money balances equal to the supply. This relationship with economists refers to the LM curve, as shown by the upward sloping curve in Exhibit 12. Okay. The intersection of the IS and LM curve determines the combination of real income and real interest rates that is consistent with both the equation of income and planned expenditure of this IS curve and equilibrium in the money market. The LM curve in Exhibit 12, the dash LM curve reflects a higher real money supply, and the solid LM curve with a higher real money supply. This intersection of the IS-LM curve occurs at a higher level of real income and a lower level of real interest rates, the aggregate demand curve. In the nominal money supply of M, it holds constant. Then a higher or lower real money supply, or M divided by P, arises because of changes in the price level. If the price level declines, the real money supply increases, and as shown in Exhibit 12, real income increases while the real interest rate declines. Conversely, an increase in price level leads to a decline in real income and an increase in real interest rates. This inverse relationship between the price level and real income, as illustrated in Exhibit 13, is the aggregate demand curve, or the AD curve. As shown in Exhibit 13, an increase in the price level of P1 and P2 reduces income from Y1 to Y2. Our development of the AD curve emphasizes only one channel through which prices affect the quantity of output demanded, i.e. planned real expenditure, the interest rates. There are, however, other mechanisms. Higher price erodes the purchasing power of retirees and others whose income is fixed in nominal terms. Similarly, higher prices reduce the real value of nominal assets, e.g. stocks and bonds, and may reduce consumption relative to current income as people seek to rebuild their real purchasing power of their wealth. Higher domestic prices also make domestically produced goods more expensive relative to imports, assuming a constant currency exchange rate. In each case, lower prices have the opposite effect, increasing aggregate expenditure and income. It should be clear that in many interesting and important aspects of the economy, the subsumed into the AD curve, savings, investment, trade and capital flow, interest rates, asset prices, fiscal and monetary policies, and more. All of these disappear behind the deceptively simple relationship between price and output/income. Before moving on to consider aggregate supply, let's look more closely at the interactions of interest rates and income implicit in movement along the AD curve. For simplicity, we assume that no changes in the fiscal or trade balances, so that maintaining the balance between aggregate expenditure and aggregate income requires that changes in investment spending equals changes in private spending or private savings. As the price level that changes in investment spending equals changes in private savings. As the price level increases, the real money supply, or M divided by P, declines. to induce a corresponding decline in money demand, the interest rate must rise so that other assets are more attractive, and income must fall to reduce the transactional need for money balances. The higher interest level, the higher interest rate induces companies to reduce investment spending. The decline in income reduces household savings. The slope of AD curve depends on the relative sensitivity of investment, savings, and money demand to income and interest rates. The AD curve will be flatter if investment expenditure is highly sensitive to interest rates. Saving is insensitive to income. Money demand is insensitive to interest rates, and money demand is insensitive to income. The first two conditions directly imply that income will have to move more to induce a large enough change in savings to match the change in investment spending. All else equal, each of the last two conditions implies that a larger change in the interest rate is required to bring money demand in line with money supply. This in turn implies a larger change in investment spending and a correspondingly larger change in savings and savings and income. Okay, aggregate supply on 975. I want to see how much I still want to read for this today. Okay, I think I'll stop my reading for today, and I'll continue the reading next time. Okay, goodbye. Okay, continue reading of the CFA Level 1 program curriculum, Aggregate Supply. Aggregate demand tells us the relationship between the price level and the amount of output demanded at those prices. To understand what price and output level will prevail in the economy, we need to add aggregate supply. The amount of output producers are willing to provide at various prices. The aggregate supply curve, or the AS curve, represents the level of domestic output that companies are willing to produce at each price level. Unlike the demand side, we must distinguish between short and long run AS curves, which differs with respect to how wages and other input prices respond to changes in final output prices, long run and short run. Are relative terms and are necessarily imprecise in respect to calendar time. The long run is long enough that wages, prices, and expectations can adjust, but not long enough that physical capital is a variable input. Capital and the available technology to use the capital remains fixed. The conditions implies a period of time, at least a few years and perhaps a decade. A truly long run in which even a capital stock or variable may be thought of as covering multiple decades. A consideration of a very long run is postponed to our discussion of economic growth in section 4. In the very short run, perhaps a few months or quarters, companies will increase or decrease output to some level without changing price. This is shown in Exhibit 14 by the horizontal line labeled VSRAS. If demand is somewhat stronger than expected, company has higher profits by increasing output as long as they can cover their variable costs. So they will run their plants and equipment more intensely, demand more efforts from their salaried employees, and increase hours of employees who are paid on the basis of hours worked. If demand is somewhat weaker than projected, companies can run their plants less intensely, cut labor hours, and utilize staff to perform maintenance and carry out efficiency-enhancing projects that are often postponed during busier periods. Okay, so this is what the aggregate supply curve looks like, with the VSR AS curve as a horizontal line, also illustrated. Over somewhat longer periods, as AS curve is upward sloping because more cost becomes variable, this is represented by the short-run aggregate supply, or the SRAS curve, in Exhibit 14. In most businesses, wages are adjusted once a year, but for companies with union contracts, several years may pass before contracts expire. The prices of raw materials and other inputs may also be established under long-run contracts. Hence, wages and other input costs are relatively flexible in the short run. and do not fully adjust to changes in output prices. As the price level rises, most companies enjoy higher profit margins and hence expand production. Exhibit 14, when prices move from P1 to P2, the quantity of aggregate output supplied increases from Y1 to Y2. Conversely, the reduction in the price level squeezes profit margins and causes companies to reduce production. Over time, however, wages and other input prices tend to catch up with the prices of the final good and services. In other words, wages and prices that are inflexible or show to adjust in the short run adjust to changes in the price levels over the long run. Thus, over the long run, when the aggregate price level changes, wages and input prices changes proportionally, so that the higher aggregate price level has no impact on the aggregate supply. This is illustrated by the vertical level aggregate supply, or the LRAS, the long run aggregate supply curve in Exhibit 14. As prices move from P1 to P2, the quantity of output supplied remains at Q1. In the long run, the only change that occurs in the price shifts to a higher level from P1 to P2. The position of LRAS is determined by the proportional outputs of the economy. The amount of output produced depends on the fixed amount of capital and labor and the available technology. The classical model of aggregate supply can be expressed as such, where K bar is the fixed amount of capital and L bar is the available labor supply. The stock of capital is assumed to incorporate the existing technological base. The available labor supply is also held constant. The workers are assumed to have a given set of skills. The long-run equilibrium price of output Y1 in Exhibit 14 is referred to as the full employment or natural level of output. At this level of output, the economy's resources are deemed to be fully employed, and labor unemployment is at its natural rate. The concept of natural rate of employment assumes that the macroeconomy is currently operating at an efficient and unconstrained level of production. Companies have enough spare capacity to avoid bottlenecks, and there is a modest, stable pool of unemployed workers. Job seekers equal job vacancies looking for transitioning into new positions. 3.3, shifting the aggregate supply and demand and supply. In the next two sections, the aggregate demand AD and aggregate supply AS models are used to address three critical macroeconomic questions: what causes an economic to expand or contract, what causes inflation to change, and changes in level of unemployment, what determines an economy's rate of sustainable growth, and how can it be measured. Before addressing these questions, we need to distinguish between 1, the long-run growth rate of real GDP, and 2, short-run fluctuations in real GDP around the long-run trend. The business cycle is a direct result of short-term fluctuations of real GDP and consists of periods of economic expansion and contraction. In an expansion, real GDP is increasing, the unemployment rate is declining, the capacity utilization is rising. In a contraction, real GDP is decreasing, the unemployment rate is rising, and capacity utilization is decreasing. Shifts in the AD and AS curve determines the short-run changes in the economy associated with the business cycle. In addition, the AD-AS model provides a framework for estimating the sustainable growth rate in an economy, which is assessed in Section 4. From an asset allocation perspective, it is important to determine the current phase of the business cycle as well as how fast the economy is growing relative to its sustainable growth rate. The expected rate of return is on equities and fixed income securities, for example, depends on estimates of growth rate of GDP and inflation. For equities, GDP growth is the primary determinant of aggregate corporate profits. For fixed income securities, the expected rate of inflation determines the spread between real and nominal rates of return. In order to use the ADAS model to analyze the economy and to make investment decisions, we need to first understand what factors causes the curve to shift. 3.1.1, the shifts in aggregate demand in addition to price factors that influence the level of spending by households, companies, governments, and foreigners, i.e. aggregate levels of expenditures, will cause the AD curve to shift. AD shifts to the right represents an increase in aggregate demand at any price levels. Exhibit 15 shows this as a shift from AD1 to AD2. A shift to the left represents a decrease in aggregate demand at any price level. This is indicated by a move from 81 to 83, key factors that directly or indirectly influence the level of aggregate expenditures and cause aggregate demand curve to shift, including changes in household wealth, consumer and business expectations, capacity utilization, monetary policies, exchange rate, growth in global economy, and fiscal policies or government spending and taxation. Shifts in aggregate demand curve, you can see 81 shifting to 82 when the real GDP or income output Y increases, and 81 shifting to 83 when it decreases. Household wealth includes the value between financial assets, e.g. cash, savings accounts, interest securities, and pensions, and real assets, e.g. real estate. The primary reason households save a portion of their current income is to accumulate wealth for consumption in the future. The proportion is disposable income. The households save depends partly on the value of the financial and real assets that they have already accumulated. If these assets increase in value, households will tend to save less and spend a greater proportion of their income because they still will be able to meet their wealth accumulation goals. As a result, an increase in household wealth increases consumer spending and shift to aggregate demand curve to the right, from 81 to 82. Essentially. In contrast, a decline in wealth will reduce consumer spending and shift the AD curve to the left. This is often referred to as the wealth effect and is one explanation of how the changes in equity prices affect economic activity. Higher equity prices increase household wealth, which increases consumer spending and reduces the amount saved out of current income. Economics studies estimate that an increase or decrease in wealth in developed countries increase or decrease annual consumer spending by 3 to 7% of the change in wealth. A smaller but still statistically significant wealth effect has been found in a number of emerging markets, developing countries. Okay, here's the wealth effect. Consumer and business expectations. Psychology has an important impact on consumers and business spendings. When consumers are confident about the future income and the stability/safety of their jobs, they tend to spend a higher portion of their disposable income. This shift of AD curve to the right. Consumer spending declines and the AD curve shifts to the left when consumer becomes less confident. Similarly, when businesses are optimistic about their future growth and profitability, they spend or invest more on capital projects, which also shifts the AD curve to the right. Capital utilization. Capital utilization is a measure of how fully an economy's production capacity is being used. Companies with excess capacity have little incentive to invest in new property, plants, and equipment. In contrast, companies who are operating in near or full capacity then will need to increase their investment spending in order to expand production. Data from OEDC and the U.S. Federal Reserve indicates that when aggregate capacity utilization reaches 82 to 85%, production brokerages arises, prompting companies to increase their level of investment spending. This shifts the AD curve to the right. Fiscal policy. Fiscal policy is the use of taxes and government spending to affect the level of aggregate expenditures. An increase in government spending, one of the direct components of AD, shifts the AD curve to the right, whereas a decrease in government spending shifts the AD curve to the left. Taxes affecting GDP indirectly through the effect on consumer spending and business investments. Lower taxes will increase the proportion of personal income and corporate pre-tax profits that consumers and businesses have available to spend and will shift the AD curve to the right. In contrast, higher taxes will shift the AD curve to the left. Monetary policies. Money is generally defined as currency in circulation plus deposit at commercial banks. Monetary policy refers to actions taken by a nation's central bank to affect aggregate output and prices through changes in bank reserves, reserve requirements, and target interest rates. Students usually get fiscal and monetary policy wrong. You just have to think monetary policy is by the central bank and fiscal policy is by the government. Most countries have fractional reserve banking systems in which the bank must hold reserves or vault cash plus deposits at the central bank at least equal to the reserved ratio times its customer deposit. Banks with excess reserve can lend them to banks that need reserves to meet their reserve requirements. The central bank can increase the money supply by 1, buying securities from banks, 2, lowering the required reserve ratio, and 3, reducing the target for the interest rate at which the banks borrow and lend reserve among themselves. In each case, the opposite action will decrease the money supply. When the central bank buys securities from banks in an open market operation, it pays for them with a corresponding increase in bank reserves. This increase the amount of deposits banks can accept from their customers. That is the money supply. Similarly, cutting the required reserve ratio increases the level of deposit, i.e., money consistent with given level of reserves in the system. If the central bank chooses to target an interbank lending rate, as the Federal Reserve targets the federal fund rate in the United States, then it must add or drain reserve through or via open market operations to maintain the target interest rates. If it raises or lowers the target interest rates, it will have a drain or add reserves in order to make reserves more or less expensive in the interbank market. Thus, open market operations and interest rate targeting are very closely related. The main distinction is whether the central bank chooses to target a level of reserve and let the market determine the interest rate, or chooses to target the interest rate and let the market or banks determine the level of reserve they desire to hold at a rate. An increase in money supply shifts the AD curve to the right, so that each price level corresponds to a higher level of income and expenditure. There are various channels through which the additional expenditures may be included. For example, the interest rate reduction requires to introduce investors to hold an additional money balance, will encourage companies to invest more into household and borrow to purchase durable goods such as cars. In addition, banks may facilitate greater expenditure by raising credit limits and loosening credit standards. Conversely, a reduction in money supply shifts the AD curve to the left. Exhibit 17 illustrates the short-run and long-run effects of expansionary monetary policy. Suppose the central bank expands the money supply in an attempt to stimulate demand if the economy is already in long-run equilibrium. The expansionary policy will shift the AD curve to the right from AD1 to AD2. In a very short run, output will expand from Y1 to Y2 without an increase in the price level. After operating at higher than normal production rates for a few months or quarters, companies will begin to push for price increases, and input prices will begin to rise as well. The aggregate supply curve will steepen and prices will increase to P3, while output declines to Y3. And input price, as input price becomes more flexible, the AS curve will steepen until in the long run it is vertical and output has returned to the long run natural level Y1, with prices rising to P4, thus expanding the money supply increases output for short run, but in the long run affects only the price level. So here's the diagram. The shifts in the AD from AD1 to AD2 and the effects of long-run aggregate supply and short-run aggregate supply. They take a neoclassical interpretation of the long-run aggregate supply. I personally like the Keynesian interpretation a little bit more, but that's just how the CFA rose. The economics section really cuts down to the bare bones. Okay. Exchange rate is the price of one currency relative to another. Changes in the currency rate affects the price of exports, imports, and aggregate demand. For example, a lower euro relative to the currency market, European exports cheaper in the world market. The foreign products sold in Europe or European inputs more expensive. Therefore, a lower euro should cause European exports to increase and imports to decline, causing the AD to shift to the right. Conversely, a stronger euro reduces. This is the J curve. Okay, I think this is the J curve. And for those who have studied economics in high school or most likely university, you'll know the effects of changing interest rates on the import and export prices through the illustration of the J curve. I don't know if they're going to talk about that though. Okay. Growth in the global economy and international trade is what links countries together and creates a global economy. Faster economic growth in foreign markets encourages foreigners to buy more products from domestic producers and increases exports. For example, rapid U.S. growth in ASEAN members, which is ASEAN members. Countries are increased their demand for foreign products. Japan has benefited from the rapid growth because of its exports to more products to them. In terms of AD and AS models, the AD curve from Japan has shifted to the right because of the increase of demand for Japanese products in ASEAN countries, resulting in higher exports. A decline in growth rates of ASEAN members' economies would have a negative effect on Japanese economy because exports will be lowered. This will cause Japanese AD to shift to the left. This is highly simplified, but makes sense logically. What happens to interest rates when the AD curve shifts? In the case of an increase in money supply, the interest rate declines at each price level because the increase in economy of income Y increases saving rates and declines to introduce a corresponding increase in investment spending, or I. In each of the other cases considered above, a rightward shift of the AD curve will increase the interest rate at each price level. With the real money supply held constant, the interest rate must rise. The income as income increases, the income and the interest rate reduces the demand for money at each level of expenditure or income, and therefore allows expenditure or income to increase without an increase in the money supply. In terms of quantity theory of money equation, this corresponds to a higher velocity of money, or V. The main factor that shifts AD curve are summarized in Exhibit 18. In each case, the impact of factors is considered in isolation. In practice, however, the various factors may be at work simultaneously, and there may be interactions among them. There is especially true when regard to expectational factors, consumers and business confidence, which are likely to be influenced by their other developments. Okay. 3.2.2 shifts in short run. We are almost getting to 1,000. Almost getting to 1,000 pages. Oh, I can't believe how long I've been reading the CFA Level 1 program curriculum. We're almost getting to 1,000. I think we'll get to 1,000 in today's video. 3.2.2 shifts in short-run aggregate supply factors that change the cost of production or expected profit margins will cause the SRAS curve to shift. These factors include changes in nominal wages, input prices, including the price of natural resources, expectations about future output prices and other price levels, business taxes and subsidies, and exchange rates. In addition, factors that shift the long-run AS curve, see section 3.3.3, will also shift the SRAS curve by corresponding amounts because the SRAS and LRAS reflects the same underlying resources and technology. As the economy's resources and technology changes, the full employment or natural level of output changes, and both the LRAS and SRAS curve shift accordingly. Changes in nominal wages shifts the short-run AS curve because wages are often the largest component of the company's cost. An increase in nominal wages raises the production cost, resulting in a decrease in aggregate supply and a leftward shift of the short-run aggregate supply curve. Lower wages shift the aggregate supply curve to the right. It is important to note that changes in nominal wages have no impact on the LRAS curve. A better way to measure the impact of labor costs on the aggregate supply curve is to measure the change in unit labor costs. We define the change in unit labor costs as percentage change in unit labor costs is equals to the percentage change in nominal wages subtracted by the percentage change in the productivity. Okay. Changes in output prices. The price of raw materials is an important component of cost for many businesses. Lowering the input prices reduces the cost of production, which in turn makes companies willing to produce more at any output price. This is reflected in rightward shift of the SRAS curve. Conversely, higher input prices increases production costs, which in turn causes companies to reduce production at any output price. This shifts the SRAS curve to the left. During the 1970s, high oil prices caused the short-run aggregate supply curve in most countries to shift to the left. In contrast, in the mid-1980s, declining oil prices in most countries, mostly because of OPEC companies having a cartel on oil prices, but that's beyond the scope. It's quite interesting. You should go read into it if you don't know. Anyways, during the 1970s, higher oil prices caused the SRAS curve in most countries to shift to the left. In contrast, in the mid-1980s, declining oil prices lowered the cost of production and shift the SRAS curve in most countries to the right. Oil prices currently have a smaller impact on global economy than in the 1970s and the 80s because most countries have reduced their reliance on oil and improved their energy efficiency, so that is now less of per unit of the GDP. Changes in expectations about future prices. The impact of expected future prices on current output decisions is not as straightforward as it may seem. First, each company is primarily concerned about the price of its own output rather than the general price level. The latter may be reflective of its costs. If it expects its own output price to rise or fall relative to the general price level, then it may increase or decrease production in response to the perceived changes in profit margins. As more and more companies become optimistic or pessimistic about their ability to raise the relative price of their products, the SRAS curve will shift to the right or to the left. In the aggregate, of course, companies can neither raise nor lower their prices relative to the general price level. Hence, shifts in the SRAS driven by such price expectations are likely to be modest and temporary. Second, considering future prices introduces temporal aspect into decision making. In the future price level is expected to be higher. Companies may decide to produce more today in order to expand inventory available for future sales, but they will only do so if the cost of carrying inventory, financing, storage, and spoilage is less than they expect to save on production costs by producing more today and less in the future. Conversely, they may cut current production and sell out of existing inventory if they expect future prices and costs to be lowered. The upshot is that expectations of higher or lower future prices are likely to shift the SRAS curve to the right or to the left, but the impact may be modest or temporary. Change in business taxes and subsidies. Higher business taxes increase production costs per unit and shift the short-run AS curve to the left. Business subsidies are a payment of the government to the producer. Subsidies for businesses lower their production costs and the shift of SRAS curve to the right. Changes in exchange rate. Many countries import raw materials, including energy and intermediate goods. As a result, changes in the exchange rate can affect the cost of production and therefore aggregate supply. A higher yen relative to the euro will lower the cost of raw materials and intermediate goods for imports to Japan to Europe. From Europe, this in turn will lower the production cost of Japanese producers and shift the AS curve in Japan to the right. Lower yen will have the opposite effect. The 3.3 shifts in long-run aggregate supply. As discussed above, the positions of the LRIS curve is determined by the potential output of the economy, potential GDP measures, and productive capacity of the economy. And this level of the real GDP can be produced at full employment. Potential GDP is not a static concept, but can increase each year at the steady rate of the economy's resource capacity grows. Therefore, any factor increasing the resource base on the economy causes the LRAS curve to shift to as shown in Exhibit 19. So the LRAS could also shift, and this is what we call economic growth. So these factors can include supply of labor and quantity of labor factors, supply in natural resources, supply of physical capital, and productivity and technology. This is quite intuitive and shouldn't be that hard to understand. I did actually make a video previously about factors that causes LRAS curve to shift, and this is what we call economic growth. For example, consider an increase in the cost of natural resources, e.g. energy, the shift of the SRAS curve to the left, but according to Exhibit 20, it has no effect on the LRAS. This presumes that there has not been a permanent change in the relative prices of the factors of production. If there has been a permanent change, companies will be forced to conserve now more expensive inputs and will not be able to produce as effectively. The LRAS curve would therefore shift to the left, just as it would if the available supply of natural resources have declined relative to the supply of other inputs. Indeed, that is the most likely cause of permanent changes in relative input prices. 3.4. Let me take a sip of my water real fast. You know why I'm so excited today? I'm so excited today because we're going to finally pass the 1,000 mark. We're going to pass the 4-digit mark. Oh, I've been waiting this day to come for months, man. Okay. 3.4 equilibrium GDP and prices. Now that we have discussed the components of the AD and AS model, we can combine them to determine the real level of GDP. And the price level equilibrium occurs where AD and AS curves intersect. At this point, the quantity of aggregate output or demand or the level of aggregate expenditure is equal to the quantity of aggregate output supplied. In Exhibit 21, the equilibrium price of GDP occurs at P1 and Y1. If the price level is above P1, then the quantity of output supplied exceeds the amount demanded. The situation will result in unsold inventories and will require a reduction in production and in prices. If the price level is below P1, then the quantity of this is important to understand. The short-run macroeconomic equilibrium may occur at the level above or below for employment, which considers the 4 possible types of macroeconomic equilibrium: long-run full employment, short-run recessionary gap, short-run inflationary gap, and short-run stagflation. Ooh, stagflation. Nobody likes stagflation. Ooh, I hate stagflation. From an investment perspective, performance of asset classes, the financial markets will differ in each of the above classes as the economy makes adjustments towards the macroeconomic equilibrium. We'll look at these differences later in the reading. Okay, long-run equilibrium. Exhibit 21 shows the long-run full employment equilibrium for an economy. In this case, equilibrium occurs when AD curve intersects the SRAS curve at the point on the LRAS curve. Because equilibrium occurs at the point where LRAS curve, the economy is at a potential real GDP. Both labor and capital are fully employed, and everyone who wants a job has one. In the long run, equilibrium GDP is equal to the potential GDP. In practice, the level of potential GDP is difficult to measure with precision because the fluctuations arises from shifts to in the aggregate demand and in the short run aggregate supply curve. The economy rarely operates at potential GDP. Thus, potential GDP is not observable from the data on actual GDP. In addition, potential GDP is determined by factors that are themselves difficult to measure. See section 4.2. Thus, bottom-up estimates of the level of potential output are also quite imprecise. However, as will be discussed in section 4, economists have confidence that the long-run growth of potential GDP can be estimate as well as price enough to provide meaningful guidance for analysts and policymakers. Hence, in the short run, economists generally focus on the cause actual GDP to grow faster or slower than their estimate of the long-run growth rate and potential output. In addition, they focus on measures that indicate, albeit imprecisely, the extent to which the economy is operating above or below productive capacity, such as unemployment capacity utilization. 3.4.2 recessionary gas cyclical fluctuations in real GDP and prices are caused by shifts in both the AD and SRAS curve, and a decline in AD or a leftward shift in AD curve results in a lower GDP and lower prices. Such declines in AD lead to economic contractions, and if such declines drive demand below the economy's potential GDP, the economy goes into a recession. Exhibit 23, when aggregate demand falls, the equilibrium shifts from point A to point B. Real GDP contracts from Y1 to Y2. The aggregate price level falls from P1 to P2 because of the decline in demand. Companies reduce their workforce and employment rates rises again. The economy is in recession. And the recession gap is measured as the difference between Y1 and Y2. And the amount by which equilibrium output is below potential GDP. Thus, a recessionary gap occurs when AD curve intersects the short-run AS curve. As the short-run equilibrium level, GDP below potential GDP. Most importantly, in contrast to full employment, equilibrium GDP is below potential GDP. So this is what a recessionary gap looks like when the short run equilibrium or the short run aggregate demand curve is lesser than the is at a level lesser than the long run aggregate supply. Any of the factors discussed in section 3.3 can cause a shift in the AD curve, tightening the monetary policies, higher taxes, a more pessimistic consumer and business, more pessimistic and consumer and more pessimistic consumers and businesses. The lower equity of housing prices reduces the AD and all possible causes for a recession. The question is, how does the economy return to full employment? This is considerable debate among economists about the answers of this question. Some economists argue that automatic self-correcting mechanism will push the economy back to its potential without the need for government action. This idea is because of the decline of prices and higher unemployment. Workers will be willing to accept lower nominal wages. Workers will do this because each currency unit of wages now buys more goods and services because of their lower prices. As a result, lower wages and input prices will cause the SRAS curve to shift to the right, see Exhibit 20, and push the economy back to full employment. This is one perspective. The problem is that The problem is that how does the economy return to full employment? There is a considerable debate among economists. Yeah, we read that already. The problem is that the price mechanism can take several years to work. As an alternative, government can use the tool of fiscal and monetary policies to shift the AD curve to the right from point B to point A. In Exhibit 22, the move of the economy back to full employment. On the fiscal side, policymakers can reduce taxes or increase government spending. On the monetary side, central banks can lower interest rates and increase the money supply. The problem, however, is that the variable lags in the effectiveness of these policies measures implies the policy adjustments may end up reinforcing rather than contracting underlying shifts in the economy. Investment implications of a decrease in aggregate demand. Aggregate demand and aggregate supply are theoretical measures that are very hard to measure directly. Most governments, however, publish statistics that provide an indication of the direction of the aggregate demand and supply and the moves over time. For example, the statistics on consumers sentiment factors, orders, or durables and non-durable goods and values of unfulfilled orders, the number of new housing starts, the number of hours worked, and the changes in inventory provides an indication of the direction of aggregate demand. And these statistics suggest that a recession is caused by a decline in AD and follows the condition are likely to occur. Corporate profits will decline, commodity prices will decline, interest rates will decline, demand for credit will decline. This suggests that following investment strategy reduce investment in cyclical companies because their earnings are likely to decline. The most is in the economic slowdown. Reduce investment in commodities and or commodity-oriented companies because the decline in commodity prices will slow revenue growth and reduce profit margins. Increase investment in defense companies because they are likely to experience only modest earnings declines and economic shutdown because governments still spend money on the defense regardless of how the economy is. And you may even argue that governments will spend more because they want to increase money supply, they want to increase government spending and stimulation of the economy. So that's why people won't invest in that. Increased investment grade or government issued fixed income securities. The price of these securities should increase as interest rates decline. Interest investments in long maturity fixed income securities because their prices will be more responsive to the decline in interest rates than the price of short-term maturity securities. Reduce investment in speculative equity securities and in fixed income securities with low credit quantity ratings. As with most investment strategies, this strategy will be most successful if it is implemented before other market participants recognize the opportunity and asset price adjusts. Okay. What is Taiwan about? The exports and percentage of GDP. Okay. Percentage of exports going to United States. Look at Mexico, 80%. Darn. So Taiwan. China only has 26% going to the United States. Oh, that's 2007. I'm not shocked. I would be shocked if it's still 26% today. Anyways, inflationary gap. Increases in aggregate demand leads to economic expansion, and as real GDP and unemployment increases, if the expansion drives the economy beyond the production capacity. However, inflation will occur as summarized in Exhibit 18. Higher government spending, lower taxes, a more optimistic outlook among the consumers and businesses, a weaker domestic currency, rising equity and housing prices, and an increase in money supply would each stimulate aggregate demand and shift the AD curve to the right. If aggregate supply does not increase to match the increase in AD, a rise in overall level of prices will result. In Exhibit 24, an increase in AD will shift the equilibrium level of AD from point A to point B. Real output increases from Y1 to Y2, and the aggregate price level rises from P1 to P2. As a result of increases in aggregate demand, companies increase their production and hire more workers. The unemployment rate declines once an economy reaches its potential GDP. However, companies must pay higher wages and other input prices to further increase production. The economy now faces an inflationary gap measured by the difference between Y1 and Y2. So the Y2 is now greater than the long run GDP. So this is what we call the inflationary gap. Exhibit 24, an inflationary gap occurs when the economy's short run level equilibrium GDP is above potential GDP, resulting in upwards pressure on the prices. So that's exactly what I just said. So as you can see, the distance or the gap between Y1 and Y2 is what we call the inflationary gap. GDP cannot remain at Y2 for long because the economy is overutilizing its resources, i.e. extra shifts of workers and hiring the plant and equipment and operating at a maximum capacity. Eventually workers become tired or burned out, and the plant and equipment wears out. The increase in general price levels and input prices will set to a motion to process the returning the economy back to potential GDP. Higher wages and input prices shift this SRA S-curve to the left from SRAS1 to SRAS2, moving the economy from point C. In Exhibit 24, again, this self-correcting mechanism may work slowly. A nation's government and or its central bank can attempt to use tools of fiscal and monetary policies to control inflation by shifting the AD curve to the left, AD2 to AD1 in Exhibit 24, so that the return to full employment occurs without the price increases. From a fiscal perspective, policymakers can raise taxes or cut government spending. From a monetary perspective, the central bank can reduce bank reserve, resulting in a decrease in the growth of the money supply and higher interest rates. Investment implications of an increase of AD resulting in an inflationary gap, and if economic statistics, consumer sentiment factors, orders of durable and non-durable goods, etc. suggest that there is an expansion caused by increase in AD. The following conditions are likely to occur. Corporate profits will increase, commodity prices will increase, interest rates will increase, inflation pressure will be built. So this is literally the opposite of what just happened. The suggests that the following investment strategies increase investment in cyclical companies because they are expected to have a large increase in earnings, reduce investment in defense companies because they are expected to have only a modest increase in earnings, increase investment in commodities and commodity-oriented equities because they will benefit from higher production and prices. Reduce investment in fixed income securities, especially longer maturity securities, because they will decline in price as interest rates rise. Rise exposure to speculative or fixed income securities or junk bonds because default risk decreases in the economy as the economy expansions. Stagflation, both high inflation and high employment. Oh, nobody likes stagflation. Stagflation is literally the worst thing on earth. Structural fluctuations in real GDP are caused by stagflation, and short-run aggregate supply declines in aggregate supply brings about stagflation. High unemployment and increased inflation increases in aggregate supply. Conversely, gives rise to high economic growth and low inflation. Exhibit 25 shows a case of a decline in aggregate supply, perhaps caused by an unexpected increase in basic material and oil prices. The equilibrium level of GDP shifts from point A to point B, the economy experiences a recession as GDP falls from Y1 to Y2, but the price level, instead of falling, rises from P1 to P2. Over time, reduction in the price and employment should put downward pressure on wages and input prices, and shifts of SRAS curve back to the right, re-establishing full employment equilibrium at point A. However, the mechanism may be painfully slow. Policymakers may use fiscal and monetary policies to shift AD curve to the right, as previously discussed, but at the cost of permanently higher prices level at point C. So this is stagflation, where SRAS increases or shifts to the left, and we have a curve that looks something like this. The global economy experienced stagflation in the mid-1970s and early 1980s. Both unemployment and inflation soared. The problem was caused by a sharp decline in aggregate supply, fueled by higher input prices, especially the price of oil. In 1973, the price of oil quadrupled. A steep global recession began in the late 1973 and lasted through early 1975. The recession was unusual because prices rose rather than declined, and would be expected in a typical demand cost return. In 1979 to 1980s, the price of oil doubled. Higher energy prices shifted SRAS curve to the left, as shown in Exhibit 25, leading to a global recession in the 1980s to 1982. In the United States, the contraction in outputs was reinforced by the Federal Reserve's decision to tighten monetary policy to fight the supply-induced inflation. Investment implications of a shift in aggregate supply, labor, and raw material costs, including energy prices, determine the direction of the shift of short-run aggregate supply. Higher costs of labor, raw materials, and energy led to a decrease in aggregate supply, resulting in lower economic growth and higher prices. Conversely, a lower labor costs, raw material prices, and energy prices lead to an increase in demand, lead to an increase in aggregate supply, resulting in higher economic growth and a lower aggregate price level. Productivity is also an important factor. Higher rates of productivity growth shifts the AS to the right, resulting in higher outputs and lower units of input prices. Lower rates of productivity growth does do the opposite and shift the AS curve to the left. From an investment perspective, a decline in AS leftward shift of a SRAS curve suggests reducing investment in fixed income, because rising output prices, i.e. inflation, put upward pressure on nominal interest rates. Reducing investment in most equity securities because profit margins are squeezed and output declines, and increasing investment in commodities and commodity-based companies because prices and profits are likely to rise. On the other hand, an increase in AS rightward shift of the SRAS curve due to higher productivity growth or lower labor, raw material, and energy costs is favorable for most asset classes other than commodities. Conclusions on AD and AS. The business cycle that results from fluctuations of GDP are caused by the shifts in the AD-AS curve. The impact of these shifts can be summarized as follows. An increase in AD raises the real GDP, lowers the unemployment level, and increases the aggregate level of prices. A decrease in aggregate demand lowers the real GDP, increases the unemployment rate, and decreases the aggregate level of prices. An increase in aggregate supply raises the GDP, lowers the unemployment rate, and lowers the aggregate level of prices. A decrease in aggregate supply lowers real GDP, raises unemployment rate, and raises the aggregate level of prices. In both curves shift the effect of combination of the above individual effects. We can look at four possible cases. Both AD and AS increases, and both AD and AS increases, real GDP will increase, but the impact of inflation will not clear unless we know the magnitude of the change, because an increase in AD will increase the price levels, whereas an increase in AS will decrease the price levels. If AD increases more than AS, the price level will increase. If AS increases more than AD, however, the price level will decline. Both AD and AS decreases. Both AD and AS decreases, real GDP and unemployment will decline, But the impact on the price level is not clear unless we know the magnitude of the changes, because a decrease in AD decreases the price level, whereas the decrease in AS increases the price level. If AD decreases more than AS, the price level will fall. If AS decreases more than AD, the price level will rise. AD increases if AD increases as AS decreases. If AD increases as AS decreases, the price level will rise, but the effect of real GDP is not clear unless we know the magnitude of the changes, because an increase in aggregate demand causes real GDP, whereas a decrease in aggregate supply decreases real GDP. If aggregate demand increases more than aggregate supply declines, then real GDP will rise. If aggregate supply decreases more than aggregate demand increases, real GDP will fall. Aggregate demand decreases and aggregate supply increases. If aggregate demand decreases and aggregate supply increases, the price level will decline, but the impact on the real GDP is not clear unless we know the magnitude of the changes, being a decrease in aggregate demand decreases real GDP, whereas an increase in aggregate supply increases the real GDP. If aggregate demand decreases more as aggregate supply increases, the real GDP will fall. If aggregate supply increases more than aggregate demand declines, the real GDP will rise. So here is a combination of what it looks like. Exhibit 26. Whether the growth of the economy in demand or supply driven has an impact on asset prices. Demand driven expansion are nominally associated with rising interest rates and inflation, whereas contradictions are associated with lower inflation and interest rates. Supply driven expansions are associated with lower inflation and interest rates, whereas supply driven contradictions are associated with rising inflation and interest rates. Woo! We make it to page number 1000. Guys, we did it. I never thought the day would come that we get to page 1000 of the CFA Level 1 program curriculum. Man, this is a big milestone for us as a community, for everyone involved in this reading. I want to thank everyone that has participated and watched any of my videos. It has been such a blessing, and I hope to continue. And I am looking forward to continue this entire book and even future readings. So I do hope my readings have been helpful, and I hope to see you guys in the next one. Goodbye. Okay, continued reading of the CFA Level 1 program curriculum. Last time we hit the 1,000 page mark. We're going to continue our reading of economic growth and sustainability. Now we should focus from the short-run cyclical movement of the economy to its long-term growth rate. Economic growth is calculated as the annual percentage change in the real GDP, or the annual change in the real per capita GDP. Growth in real GDP measures how rapidly the total economy is expanding. Per capita GDP, defined as real GDP divided by population, determines the standard of living in each country and the ability of the average person to buy goods and services. Economic growth is important because rapid growth in per capita GDP can transform a poor nation into a wealthy one. Even small differences in growth rates of per capita GDP, if sustained over time, has a large impact on the standards of living. We should think of the growth rate of GDP as the equivalent of making a big difference of rate of a return on our portfolio. Small differences in returns compound over many years, makes a big difference. Nevertheless, there is a limit to how fast an economy can grow. Faster growth is not always better for an economy because there are costs associated with these growth, such as higher inflation, potential environmental damages, and lower consumption and high savings needed to finance the growth. This raises an issue of sustainable growth, which requires an understanding of the concept of potential GDP. Recall, the potential GDP measures the productive capacity of the economy and is the level of real GDP that an economy could produce if capital and labor are fully employed. In order to grow over time, an economy must add to its productive capacity. Thus, the sustainable rate of economic growth is measured by the rate of increase in the economy's productive capacity, or potential GDP. It is important to note that the economists cannot directly measure potential output. Instead, they estimate it using a variety of techniques discussed later in this reading. For global investors, and estimating the sustainable rate of economic growth for an economy is important for both asset allocation and security selection decisions. Investors need to understand how the rate of economic growth differs among countries and whether these growth rates are sustainable. When examining the GDP data, global investors need to address a number of questions, including the following. What are the underlying determinants of sources of growth in the country? Are these sources of growth likely to remain stable or change over time? Can we measure them and forecast sustainable growth or for different countries? The production function of a potential GDP, the neoclassical or solo growth model in the framework used to determine the underlying source of growth for an economy. The model shows the economy's productive capacity and potential GDP increase for two reasons. One, accumulation of such input as capital, labor, and raw material used in production, and discovery and application of new technology that makes the input in production processes more productive. That is able to produce more goods and services for the same amount of input, so being more productive. The models are based on the production function that provides the quantitative link between the level of output and the economy can produce and input used in the production process given the state of technology. A two-factor production function with labor and capital as inputs is expressed mathematically as such. Where Y denotes the level of aggregate output in the economy, L the quantity of labor or number of workers in the economy, K is the capital stock or the equipment and structure used to produce goods and services, and A represents technological knowledge or total factor productivity, TFP is a scale factor that reflects the portion of growth that is not accounted for by the capital and labor inputs. The main factor influencing TFP is technological change. Like potential GDP, TFP is not directly observed in the economy and must be estimated. The production function shows that output in the economy depends on input and levels of technology. The economy's capacity to produce goods grows when these inputs increase and or technology advances. The more technologically advanced the economy is, the more output it is able to produce for the given amount of input. Two assumptions about the production functions provide a link to microeconomics. First, we assume that the production's functions have constant rates of returns of scale. This means that if all the inputs in production process are increased by the same percentage, the output will rise by the percentage. Thus, doubling all inputs will double output. Second, we assume that the production function exists diminishing marginal productivity with respect to any individual input. This property plays an important role in assessing the contributions of labor and capital to economic growth. Marginal productivity looks at the extra output in the produced form. 1 unit increase in an input if the other inputs are unchanged if applies to any inputs as long as other inputs are held constant. For example, if we have a factory of a fixed size, we add more workers to the factory. The marginal productivity of labor measures how much additional output each additional worker will produce. Diminishing marginal productivity means that at some point the extra output obtained from each additional unit of the input will decline. In the above example, if we hire more workers at the existing factory, fixed capital input in this case, output will rise by a smaller and smaller amount. With each additional worker, traditionally economists focus on the labor inputs and how the productivity of labor would decline given a fixed amount of land. The traditional growth theory, where labor is the only variable input, was developed by Thomas Malthus in his 1798 publication essay of the principles of population. Malthus argued that the population and labor force grows. The additional output produced by additional workers would decline essentially to zero, and there will be no long-term economic growth. The gloomy forecast caused other label economic of dismal science. The dire predictions implied by declining marginal productivity of labor never materialized. And economists changed the focus of analysis from the labor to capital. In this case, if we add more and more capital to a fixed number of workers, the amount of additional output contributed by each additional amount of capital will fall. Thus, if capital grows faster than labor, capital will become less productive, resulting in slower and slower growth. Diminishing marginal productivity of capital has two major implications for potential GDP. One, long-term sustainable growth cannot rely solely on capital deepening investment that increases the stock of capital relative to labor. More generally, increasing the supply of some inputs relative to other inputs will lead to diminishing returns and cannot be the basis for sustainable growth. Given the relative scarcity of high productivity of capital in developing countries, the growth rate of developing countries should exceed those of developed countries. As a result, there should be a convergence of incomes between developed and developing countries over time. Because of diminishing returns of capital, the only way to sustain growth in potential GDP per capita is through technological change or growth in total factor productivity. This results in an upward shift in the production function. The economy produces more goods and services using the same level of labor and capital inputs. In terms of the formal production function shown above, this is reflected by the increase in the technology parameter A. Using the production function, Robert Solow developed a model that explains the contribution of labor, capital, and technology, total factors productivity, to economic growth. The growth accounting equations shows that the rate of growth of potential output equals growth in technology plus the weighted average growth rate of labor and capital. Growth in potential GDP equals growth in technology plus WL, or the growth in labor, and WC, the growth in capital, where WL and WC are the relative shares of capital and labor and national income. The capital shares is the sum of corporate profits, net interest incomes, net rental incomes, and depreciation divided by GDP. The labor shares of the employee compensation divided by GDP for the United States, WL and WC, are roughly 0.7 and 0.3 respectively. The growth accounting equation highlights a key point. The contribution of labor and capital to long-term growth depends on the respective shares of national income. For the United States, because labor's shares is higher, an increase in growth rates of labor will have a significant larger impact, roughly double, on the potential GDP. Growth then will have an equivalent increase on the growth rate of capital. The growth accounting equation can be further modified to explain growth in per capita GDP because it measures the standard of living and purchasing power of the level of GDP and comparing economic performance amongst countries. Transforming the growth accounting equation into per capita terms results in the following equation: growth per capita potential GDP equals to growth in technology plus the growth in capital minus growth to capital to labor ratio. The capital to labor ratio measures the amount of capital available per worker. This is weighted by the share of capital in the national income, because capital share in national income is in the U.S. economy is 0.3. 1% increase in the amount of capital available for each worker increases per capita output, but only 0.3%. The equation shows that improvements in technology are more important than capital in raising the economy's standards of living. 4.2 source of economic growth. The growth accounting equation focuses on the main determinants of growth: capital, labor, and technology, and omits a number of other sources of growth to simplify the analysis. For many countries, however, natural source of human capital input play an important role in explaining economic growth. Therefore, there are 5 important sources of growth for an economy: labor supply, human capital, physical capital, technology, and natural resources. These sources of growth determines the capacity of economy to supply goods and services. Labor supply, growth in the number of people available to work. Quantity of workforce is an important source of economic growth and partially accounts for the superior growth performance among the advanced economies, the U.S. economy versus the European and Japanese economies. Most developing countries such as China, India, and Mexico have large potential labor supply. We can measure the potential size of the labor input and the total number of hours available for work as the given function below. It's quite intuitive. The labor force is defined as a portion of the working age population over the age of 16 and that is employed or available for work but not working or unemployed. The contribution of labor to overall output is also affected by changes in average hours worked per worker. Average hours worked is highly sensitive to the business cycle. However, the long-term trend has been towards a shorter work week, and in advanced countries, this development is the result of legislation, collective bargaining agreements, and growth in part-time and temporary work. Human capital, in addition to quantity of labor, quality of the labor force is important. Human capital acknowledges the accumulative knowledge of skills and workers acquired from education, training, and life experience. It measures the quality and work of the workforce in general. Better education and skilled workers will be more productive and more adaptable to changes in technology. So I was just drinking water. It's kind of a cultural tradition of this channel to talk about what I'm drinking, isn't it? In economies, human capital is increased through investment in education and on-the-job training. Like physical capital, investment in education is costly. Studies show that there is a significant return on education. That is, people with more education earn higher wages. Moreover, education may also spill over into externality impacts. Increasing the education level of one person may not only raise the output of the person, but also the output of those around him or her. The spillover effects operates those that link between education and advances in technology. Education not only improves the quality of labor force, but also encourages growth through innovation. And investment in health is a major contribution to human capital, especially in developing countries. Physical capital stock and physical capital stock, the accumulated amount of building machinery and equipment used to produce goods and services, increases from year to year as long as net investment or gross investment less depreciation of capital is positive. Thus, countries with a higher rate of investment should have a growing physical capital stock and a higher rate of GDP growth. Exhibit 27 shows the level of business investment as a share of GDP. The exhibit shows significant variations across countries, with the investments share in the United States being low in comparison to other developed countries. As is evident in Exhibit 27, the correlation between economic growth and investment is high. Economies that devote a large share of GDP to investments such as China, India, South Korea have high growth rates. The fastest growing economies in Europe over the last decade, Ireland and Spain, have the highest investment to GDP ratio. Economies that devote a smaller share of GDP to investments such as Brazil and Mexico has a slower growth rate. The data shows why Chinese economy has expanded at such a rapid rate, achieving an annual GDP rate of over 10% or over the last 2 decades. Investment spending in China, new factories, equipment, and infrastructure as a percentage of GDP is the highest in the world. So here's the data. Technology, the most important factor affecting economic growth is technology, especially in developed countries such as the United States. Technology refers to the process of a company uses to transform inputs into outputs. Technological advances are discoveries that make it possible to produce more or higher quality goods and services with the same resource of input. At some time, technological progress results in creation of new goods and services. Finally, technology processes improves how efficient businesses are organized and managed. Technological advances are very important because they allow an economy to overcome the limits imposed by diminishing marginal returns. Thus, an economy will face limits to growth if it relies exclusively on expanding the inputs and factors of production. Because most technological changes is embodied in new machinery, equipment, and software, physical capital must be replaced and perhaps expanded in order to take advantage of changes in technology. One of the key drivers of growth in developed countries over the last decade has been informational technology or IT sector. Growth in IT sector has been driven by technological innovation that has caused the price of key technologies such as semiconductors to fall dramatically. The steep declines in prices have encouraged investment in IT at the expense of other assets. The sector has grown very fast and has made a significant contribution to economic growth. Employment and exports. Countries can innovate through expenditures, both public and private, on research and development (R&D). Thus, expenditures on R&D and the number of patents issued, although not directly measuring innovation, provides some useful insights into innovation performance. Countries can also acquire new technology through imitation or copying technology that developed elsewhere. This embodiment of technology as capital goods can be able to enable relative poor countries to jump ahead of technology's leaders. Total factors, productivity, TFP, is the component of productivity that proxies technological progress and organizational innovation. TFP is the amount by which output would rise because of improvements in the product In the production basis, it is calculated as residual, the difference between growth rate and potential output, and the weighted average growth rate of capital and labor specifically. Natural resources, raw materials, are essential input to growth and includes everything from available land, oil to water. Historically, consumption of raw materials has increased as economies have grown. There are two categories of natural resources. Renewable resources are those that can be replenished, such as forests. For example, a tree is cut, a seedling can be replanted, and a new forest harvested in the future. Non-renewable resources are finite resources that are depleted once they are consumed. Oil and coal are examples. Natural resources account for some of the difference in growth among countries today. Some countries, as Brazil and Australia, are well known, as well as those in the Middle East, have relatively high per capita income because of their resource base. Countries in the Middle East have large pools of oils. Brazil has abundance in suitable for large-scale agricultural production, making it major exports of coffee, soybeans, and beef. Even though natural resources are important, they are not necessarily for a country. For a country to achieve a high level of income, provided they can acquire prerequisite inputs through trade. Countries in East Asia, such as Japan and South Korea, have experienced rapid economic growth, but only few natural resources. 4.3 measures of sustainable growth. Measuring how fast an economy grows is an important exercise. Economists project potential GDP into the future to forecast the sustainable growth path for the economy. An economy's potential GDP is an unobserved concept that is approximated using a number of alternative methods. It is important to note that estimating of an economy's potential growth can change as new data becomes available. Being able to understand such a change is critical for financial analysts, because equity returns are highly dependent on a suitable rate of economic change. We discussed this in previous sections, that the growth rate of potential GDP depends on the rate of technological progress, as well as the growth rate of the labor force, the physical and human capital, and natural resources. We could how we can summarize all these factors that are driving economic growth and development method to measure / estimate growth rates of potential GDP. One way to use is the growth accounting equation discussed in section 4.1. So this is the equation. The problem with this approach is that there are no observed data on potential GDP or on total factor productivity, and both must be estimated. In addition, data on the capital stock and the labor and capital shares of natural income are not available for many countries, especially in developing countries. As an alternative, we could focus on the productivity of labor force. When we generally have more reliable data, labor productivity is defined as the quantity of goods and services, or real GDP, that a worker can produce in an hour of work. Our standard of living improves if we produce more goods and services for each hour of work. Labor productivity is calculated as real GDP for a given year divided by the total numbers of hours worked in that year. Counting all workers, we use total hours rather than the number of workers to adjust to the fact that not everyone works the same amount of hours. Therefore, we need to understand the factors that market labor more productive. Productivity is determined by factors that we examine in the preceding sections. Education and skill of workers, or human capital, investment in physical capital, and improvements in technology. An increase in any of these factors will increase the productivity of labor force. The factors determining labor productivity can be derived from the production function under the assumption that of constant returns of scale, where a doubling of input causes output to double as well. Dividing the production factor by 1 divided by L, we get the following, where Y divided by L is output per worker, which is a measure of labor productivity. The equation states that labor productivity depends on physical capital per worker. and technology, recalling that A can also be interpreted as total factor productivity as the equation indicates. Labor productivity and total factor productivity are related by distinct concepts. The TFP is a scale factor that does not depend on the mix of inputs to specific inputs. On the other hand, as shown in this equation, labor productivity output per worker depends on both the general level of productivity reflected in FTP and the mix of inputs increases in either FTP or capital to labor ratio boosts labor productivity. Because both output and labor input can be absorbed, labor productivity can be measured directly. Labor productivity is a key concept for measuring the health and prosperity of an economy and is sustainable for rates of growth. An analyst examining the growth prospects of the economy needs to focus on the labor productivity data for that country. Labor productivity largely explains the differences in living standards of the long-term sustainable growth rate among countries. The distinction between the level of growth rate and the productivity is important to understand. Exhibit 28 provides such a comparison for selected countries. Level of labor productivity. The higher the level of labor productivity, the more goods and services the economy can produce with the same number of workers. The level of labor productivity depends on the accumulated stock of human and physical capital and is much higher in the developed countries. For example, China has a population of over 1.4 billion people compared to over 325 million people in the United States. Because of its much larger population, China has significantly more workers than the United States. The United States is measured by our GDP is much larger. However, as shown in Exhibit 28, the United States has the highest level of productivity in the world, producing over $55 of GDP per hour. Similarly, workers in France, Germany, Ireland have high levels of productivity. In comparison, Mexican workers produce only $18.6 worth of GDP per hour. Thus, U.S. workers have nearly 3 times more productive than Mexican workers. That's not going to be something too politically correct to say. Growth rate and labor productivity. The growth rate of labor productivity is the percentage increase in productivity over a year. It is among the economic statistics that economists and financial analysts watch most closely. In contrast to levels of productivity, the growth rate of productivity is typically higher in developing countries where human and physical capital is scarce but growing rapidly. Of productivity growth is rapid, it means that some number of workers can produce more and more goods and services. In this case, companies can afford to pay higher wages and still make a profit. Thus, higher rates of productivity growth will translate into raising profits and higher stock prices. In contrast, persistently low productivity growth suggests that the economy is in bad shape. Without productivity gains, businesses have either to cut wages or boost prices in order to increase profit margins. Lower rates of productivity growth can be associated with slow growth profits and declining stock prices. Measuring sustainable growth, labor productivity data can be used to estimate the rate of sustainable growth of an economy. A useful way to describe potential GDP is as a combination of aggregate hours worked and the productivity of these workers. So here's the function. Thus, potential growth is a combination of long-term growth rates of the labor force and the long-term growth rate of labor productivity. Therefore, if the labor force is growing at 1% per year and productivity per worker is raising at 2% per year, then potential GDP adjusted to inflation is raising at 3% per year. Okay, let's go to the summary. This reading introduces important macroeconomic concepts and principles of macroeconomic forecasting and related investment decision making. Macroeconomic examines the economy as a whole by focusing on country aggregate output of final good and services, total income, aggregate expenditure, and to generate price levels. The first step in macroeconomics analysis is to measure the size of an economy. Gross domestic product enables us to assign a monetary value to an economy's level of output or aggregate expenditures. In the interactions of aggregate demand and aggregate supply determines the level of GDP as well as the general price level. The business cycle reflects shifts in aggregate demand and short-run aggregate supply. The long-term sustainable growth rate of the economy depends on growth in supply and quantity of labor, inputs, labor, capital, and natural resources, and advances in technology. From an investment perspective, macroeconomic analysis and forecasting are important because business profits, asset valuation, interest rates, and inflation rates depends on the business cycle, and in short to intermediate terms on the drivers of sustainable economic growth in the long term. In addition, it is important to understand fiscal and monetary policies, economic impact on the implications of inflation, household consumption and savings, capital investment, and exports. GDP is the market value of all final goods and services produced with a country. Within a country in a given time period. GDP can be valued by looking at either total amount spent on a good and services produced in the economy or the income generated in producing these goods and services. And they should be equal to each other theoretically. GDP counts only final products of newly produced goods and services during the current time period. Transfer payments on capital gains are excluded from GDP. With the exception of owner-occupied housing and government services, which are estimates of imputed values. GDP includes only goods and services that are valued by being sold in the market. Intermediate goods are excluded from GDP in order to avoid double counting. GDP can be measured either from the value of final output or by summing the value added at each stage of the production and distribution process. The sum of the value added by each stage is equal to the final selling price of the good. Nominal GDP is the value of production using the prices of the current year. Real GDP measures production using constant price of the base year. The GDP deflator equals the ratio of nominal GDP to real GDP. Households earn income in exchange for providing directly or indirectly through ownership of business. The factors of production, labor, capital, natural resources, including land. From the income, they consume, save, and pay net taxes. Businesses produce most of the economy's output/input and invest to maintain and expand productive capacity. Companies retain some earnings but pay out more into revenues as income to the household sector as taxes to the government. The government sector collects taxes from households and businesses and purchases goods and services for private business sectors. Foreign trade consists of exports and imports. The difference between the two is the net export. If the net export is positive or negative, the country spends less or more than it earns. Net exports are balanced by accumulation of either claims on the rest of the world. Net export is greater than zero, or obligations of the rest of the world. Net exports is lesser than zero. Capital markets provide a link between saving and investment in the economy. From the expenditure side, GDP includes personal consumption. Gross personal consumption, which is C. Gross private domestic investment, which is I. Government spending is G, and net exports is X minus M. Exports, M is imports. The major categories of expenditure are often broken down into subcategories. Growth, private domestic investment includes both investment from fixed assets, plant and equipment, and charges and inventories. In some categories, government investment spending is separated from government spending. National income is the income received by all factors of production used in generating the final output. It equals GDP minus the capital consumption allowance or depreciation and a statistical discrepancy. Personal income reflects pre-tax income received by households. It equals national income plus transfers minus distributed corporate profits, corporate income taxes, indirect business taxes. Personal disposable income equals personal income minus personal tax. Private savings must equal investment plus the fiscal and trade deficits. That is, S equals I plus G minus T plus X minus M. Consumption spending is a function of disposable income. The marginal product propensity to consume represents the fraction of an additional unit of disposable income that is spent. Investment spending depends on the average interest rate of the level of aggregate income. Government purchases and tax policy are often considered to be exogenous variables determined outside of the macroeconomic model. Of actual taxes collected depends on income and are therefore endogenous and is determined within the model. The IS curve reflects a combination of GDP and a real interest rate such that aggregate income/output equals planned expenditures. The LM curve reflects the combination of GDP and the interest rate such that the demand and supply of real money balances are equal. Combining the IS and LM relationship yields an aggregate demand curve. Aggregate demand and aggregate supply determines the level of real GDP and the price level. Aggregate demand curve is the relationship between the real output or GDP, demanded, and the price level or holding underlying factors constant. Movements along the aggregate demand curve reflects the impact of price on demand. The aggregate demand curve is downward sloping because the rise in the price level reduces wealth, rises real interest rates, and rises the price of domestically produced goods versus foreign goods. The aggregate demand curve is drown assuming consuming a constant money supply. The aggregate demand curve will shift if there are changes in a factor other than price. In the short run, aggregate supply curve is upward sloping because higher prices result in higher profits and induces businesses to produce more, laborers to work more. In the short run, some prices are sticky, implying that some prices do not adjust to change in demand. In the long run, all prices are assumed to be flexible. The long run aggregate supply curve is vertical because output crossed the long-run aggregate supply curve is vertical because input costs adjusted to change in output prices, leaving the optimal level of output unchanged. The position of the curve is determined by the economy's level of potential GDP. The level of potential output, also called full employment or natural level of output, is an unobservable and difficult to measure precisely. The concept represents an efficient and unconstrained level of production at which companies have enough spare capacity to avoid bottlenecks, and there is a balance between the pool of unemployed workers and a pool of job openings. The long-run aggregate supply curve will shift because of changes in labor supply in physical and human capital and productivity or technology. The short-run supply curve will shift. The short-run supply curve shift because of changes in potential GDP, nominal wages, input prices, expectations about future prices, business taxes and subsidies, and exchange rates. The business cycle and short-term fluctuations in GDP are caused by shifts in aggregate demand and aggregate supply. When the level of GDP in the economy is below potential GDP, such as recessionary situations, exerts downwards pressure on the aggregate price level. When the level of GDP is above potential GDP, such as overheated situation, puts upwards pressure on the aggregate price level. Stagflation, a combination of high inflation and weak economic growth, is caused by decline in the short-run aggregate supply. The sustainable rate of economic growth is measured by the rate of increase in the economy's productive capacity of potential GDP. Growth in real GDP measures how rapidly the total economy is expanding. Per capita GDP defines as real GDP divided by population reflects the standard of living in a country. Real GDP growth rate and levels of per capita GDP vary widely among countries. The source of economic growth includes the supply of labor, the supply of physical and human capital, raw materials, and technological knowledge. Output can be described in terms of production functions. For example, Y equals this, and L. The factors of productivity is a skill factor that reflects the portion of output growth that is not accounted for by changes in capital and labor. Inputs TFP is mainly a reflection of technological changes. Diminishing marginal productivity implies that increasing the supply of some inputs relative to other inputs will lead to diminishing returns and cannot be on the basis of sustainable growth. In particular, long-term sustainable growth cannot rely solely on capital deepening. It is that is increasing the stock of capital relative to labor, given the relative scarcity of high productivity of capital in developing countries. The growth rate of developing countries should exceed that of developed countries. The labor supply is determined by population growth, the labor force participation rate, the net immigration of capital stock in a country increases when investment correlation between long-run economic growth and the rate of investment is high. In addition to labor, capital, and technology, human capital, essentially the quantity of labor force and natural resources, are important determinants of output and growth. Technological advances are discoveries that make it possible to produce more and or higher quantity goods and services with the same resources or inputs. Technology is the main factor affecting economic growth in developed countries. The sustainable rate of growth in an economy is determined by the growth rate of the labor supply plus the growth rate of the labor productivity. Okay. So we finished reading 16. We're gonna get into reading 17 next time. Also still in economics, but we're gonna be talking about the business cycle, one of the very interesting and fun topics. So I do hope my readings have been helpful, and I hope to see you guys next time. Goodbye.